It's our week 3 update video. This is Professor Hassey, Business 630 Corporate Finance. Today's date is Saturday morning, February 19th, 2022. A couple big things in today's update meeting, update video. I've last couple days, as I was grading the case number 1, and I'll be posting those grades tomorrow, Sunday, had some late posts of some of our students, which got extensions, and that's not a problem, but that's putting me a little bit behind all my posting. And I do not post all the grades to Blackboard until I've graded every one of the cases. So that'll be up no later than tomorrow morning, Sunday. But in going over the cases and going over the course thus far, I've decided to make a couple of changes to our course calendar just to provide better study time for all of you and some just creating a better atmosphere to learn in our course. And this is what I've done, and I've posted this to Blackboard in our Blackboard site, also in the week number 3 file folder. And I've made a couple of changes. There is going to be a case this week, case number 2. It is due next Sunday, February 27th, but it is not going to be a spreadsheet work. It's just going to be a similar APA format to like you did in case number 1. And I will post case number 2 tomorrow, but talk a lot about in my video in just a minute about the case number 2 work. Then I have altered case number 3 to be due March 6th. That's the next week. That will be a spreadsheet format doing a capital budget analysis. Then we have case number 4. You get a week off, and then case number 4, which is due March 20th, that will be a PowerPoint format, be some financial planning, analysis, that type of work on a PowerPoint format. And then the course assessment case paper is due the last Sunday of our class, March 27th. That will be an APA and spreadsheet, capital budget analysis, risk analysis, summing up the whole course. And you'll get that case next week in week number 4. At the end of the week, you'll get that, and I'll introduce it in my Friday update video next week. So that's I've made a couple adjustments. We're covering the same material. I'm just moving it around a little bit to make the course a little bit better for you, in my opinion, and also have a better opportunity for us to cover all the specifics that we have to cover in our course. So please note those adjustments to our course schedule and in your records, knowing when the cases are due. Again, the next 2 weeks, 2 cases will be due, case 2 and case 3 over the next 2 weeks. All right, so there's that. Now let's take a look at our subject at hand for this week. Well, as you all know, these first couple weeks of our class have been talking about risk, looking at the definition of capital fundraising, bonds, stocks, that sort of thing. And it's all leading up to an investment in assets and how we get the capital to fund those assets. And that's going to be our discussion over the next few weeks. But I want to highlight our discussion these first few weeks with our case number 2 this week. And we talked about bonds. What is the major funding for debt for corporations? We talked about stock this week in our week 3 about the definition of stock, capital gain, the constant growth model to determine the intrinsic value of a stock, and such and such and such and such. Well, this all leads up to what we're going to be doing in case number 2 and summarizing our first 3 weeks of class, and that is the cost of capital. If you go to your week number 3 review notes, which I've posted last week and we looked at a little bit on our lecture video on Monday, I've updated a little bit in this cost of capital segment. In other words, we use bonds to attract fundraising or capital. What's the cost of a bond? Well, it's the coupon rate on the bond. We also, in case number 1, determined the required rate of return on invested stock, the capital asset pricing model. You did that calculation for your company based on the risk in the market and the risk of the company in the market with their beta. And that's basically called the cost of equity. Well, when we combine the cost of debt and equity, it becomes weighted average cost of capital. And that weighted average cost of capital basically sums up in relationship to the capital structure of a company weighted to the cost of debt and equity for that business. What is the average cost of getting capital to fund assets for a company? Also, that weighted average cost of capital can be used in a variety of different things. Remember, the higher the cost of capital, the greater the cost and the expected return on an investment for the investors. In other words, if a company's risk is high, then it's going to cost their money. In the cost of debt, the credit rating drives the interest rate on coupons. In the company's risk and return averages over a 4 or 5 year weighted period determines the beta, which determines the cost of equity in the capital asset pricing model. The more risky a company is, the higher their money. And the higher the cost of the money makes it more pressure to utilize and invest in assets that are going to cover that cost of debt. Also, the higher the cost of capital, the greater the less value a company is. In other words, the company is worth less in the market because of the cost of capital. So it adds a whole different array of different things by determining the cost of fundraising for a company. And that's what we're summarizing this week number 3 and case number 2, taking the information from case number 1 and finding some additional data in relation to the risk and the expected return and cost of capital for a particular company. And so I want to go over this spreadsheet here, which kind of summarizes the weighted average cost of capital. Last week, in case number 1, you did this section here, the cost of equity. You found the risk, you were given the risk-free rate, you were given the market return, you were given the beta of the company, and you put that into this equation, the risk-free rate plus the market premium times the beta of the company, the market premium determined by the market rate of return, in this case 8.5, minus the risk-free rate, times the beta, and we get 11.88%. And many of you came up with your calculation for your firm based on the data I gave you in case number 1, and you've done it very well. All of you did it very well. So that's the cost of equity. That's the expected return that investors expect to get in the future by taking the risk of investing in equity in their business. Now, the cost of debt is pretty simple. The cost of debt is the average interest rate on the debt of the company, the long-term debt of the company, not accounts payable or accruals, but long-term debt. And that interest rate is, in this case, the example here, as you can see, is 10%. The company's tax rate, their corporate tax rate, both federal and state combined, is 40%. Taking that 40% tax rate and applying it to the interest rate on the debt, I can determine the after-tax cost of debt to the company. In other words, they're going to pay 10% on the debt, but because of tax laws, you can deduct interest expense on debt on your tax return. So your true cost of debt is not 10%, but actually 6% when you take into account the tax rate of the company. And how did I get that 6%? I took the interest rate on the debt, 10%, times 1 minus their corporate tax rate. So in this case, it's 10% times 1 minus 40%, which is 60%. 60% of 10% is 6%. So that's their cost of debt. So now I have two numbers. I have what it's costing the company after taxes to borrow money, and also what it's costing them in capital to put their equity value on the market for investor investment. 11.88% cost of equity by the capital asset pricing model, 6% cost of debt after taxes. And then also in case number 1, I ask you, and this is why I did that, I ask you to find the capital structure of your firm, the relationship of debt, the relationship of equity to assets. It needs to total 100%. So if you can see my example here, the capital structure of this particular company is 44% debt, 56% equity. Now, using those capital structure percentages and taking into account the after-tax cost of debt and the cost of equity, I can determine this company's weighted average cost of capital. And what it is, it's exactly what it means. It's the weighted average. It takes the weight of debt, 44%, the weight of equity, 56%, and multiplying those percentages times the appropriate cost of debt and cost of equity for this particular company. And notice what I did. I took 44%, the percentage of debt of assets, times 6%, and I got the weighted cost of debt, 2.64%. I took the weighted equity percentage to assets of 56% times the cost of equity, the required rate of return on investment, 11.88%, and got 6.65%. Add those two together, I get 9.29%. That is the weighted average cost of capital at this particular moment in time based on their coupon rate or their debt rate of debt. Now, naturally, for most corporations, that cost of debt will be an average amount because a lot of companies have many different types of long-term debt. So you just average out that interest rate. And the required rate of return on equity in the market in relationship to how the company is funded currently, 44 to 56. And it's 9.29%. That's what it's costing them to attract capital today. That's their cost of money. It's called WACC. It's called the cost of capital. It's called the hurdle rate. It can be called the opportunity cost. It can be the cost of cash. It can also be called the discount rate, and we'll see more of that in a couple of weeks. But in other words, it's our cost of money. And that tells us a lot of things about a company. It tells us the higher the cost of money, the more expensive it is to get capital. It tells us that in order to make an investment in an asset, they have to generate a greater return, more greater than 9.29%. That's why it's called the hurdle rate. You have to make more return greater than your cost of money. Also, it has a lot to do with the valuation of a company. Let's say a company has free cash flow of $1 million. $1 million is their free cash flow, the amount of capital being generated after operations. So their free cash flow is equals $1 million. Okay, well, if I take that free cash flow, $1 million, and divide it by the weighted average cost of capital that we just calculated, 0.0929, which is our cost of capital, I get this number. What is this number? It's $10,764,262.65. Let's round. $10,764,263. That is considered this company's valuation. That's what they're worth. The free cash flow is generating $1 million a year, and it's costing them 9.29% to generate that free cash flow. That means they have to have an asset base of $10,764,263 to generate that return of free cash flow. Excuse me for the phone. So that is their valuation of assets. It gives you the value of the assets of the company. It doesn't tell you the value of the company because then you have to take into account that you have to subtract from that the debt to get the equity value, but it gives you the valuation of the assets of the company. If I take this calculation and then all of a sudden determine, or due to my company strategy and efficiency, let's say if I decide that I can create in the next year my weighted average cost of capital to go down to 8.5%. If I lower my cost of capital by efficiency, by getting rid of debt, by making more money, whatever, reducing my risk to 8.5%, notice what the value of my assets become. $11,764,706. the cheaper the money, the greater the value of my business. Here, the WACC is equaling 9.29%. Here, the WACC is equaling 8.50%. Money is cheaper, the company's is worth more. That's a very important number in financial management. CFOs, CEOs, corporate managers, their job is to create a return and in a lower risk environment for their investors. By lowering that risk, making money cheaper, they create a greater value based on the working capital and the cash flow that they generate from their business. That's a very important factor in financial management. And that's one of the major factors that are going to be driving our discussions after week 3. What is our risk? What is the cost of our capital? How does that apply to additional strategies as our key points going forward into next week? And that summarizes basically the first 3 weeks of our course. These numbers are risk evaluation, these market risks, these organizational risks, these liability risk in the company, these financial risks, all have to do with determining our cost of money. In the environment of creating the mix of debt and equity in our business, our corporate tax rate, all drives these key numbers that we're going to be using in strategic decision making going forward in our class. So case number 2 has to do with finding these numbers for your company. You're not doing this analysis in case number 2. That's going to be in later on. But you're going to be determining the weighted average cost of capital for your firm based on the information I give you in the case. And then you're going to write a little interpretation of that. So that's the update video for this week. Remember, we're updating our calendar. There is a case this next week, but it's going to be a regular APA format, same format as case 1. I'll be posting case number 2 tomorrow, Sunday in the morning, so you can begin work on it. Again, extensions will be available, but I don't think there's going to be needed for many extensions in case number 2. It's only about 2 or 3 pages long, a couple of figures you got to calculate and then interpret, pretty short. I decided to, again, alter our case calendar, and it's going to prove better off in your ability to get most out of this course. So that's where we stand today. So look for that case tomorrow. I will send you an email when that case is posted. Here's our update video on concluding week 3. Make sure you understand this concept from the spreadsheet in your review notes on the cost of capital and summarizing bonds and stocks and their costs to a company. Thanks, everybody. Have a great weekend. Case number 1 results will be posted no later than tomorrow, Sunday, so you can get those. And have a great weekend. We'll see you next time. Adios.